All right, I am going to go ahead and get started here. First, couple of brief announcements for everybody. I just want to make sure everyone understands that the Intros app that we've been using is available. It's on the newsletters I send out. There's a link, and basically what Intros is, it is a you sign up, and every Monday you will get an email asking you if you want to participate. You just click yes or no. If you say no, you're done. If you say yes, it will match you up with somebody else, another left fielder. It's only for our community. So another left fielder, you'll match up with them, and you'll schedule a time to talk to them. So it's been really popular. It's just a way to connect one-on-one with other people in our community. And as you know, that's one of the things we're working on this year, is to increase the networking opportunities. I am fortunate that I get to talk to everybody, when we do introductory calls, but what we're trying to do is have everybody else have those relationships as well. So if you're interested, the next time the newsletter comes out, sign up for Intros, or if you're really excited about it, want to get in on it soon, you can just let me know and I will send you the link. Another thing we are doing for networking for infielders is we're having what we're calling Mound Visits. And those were very irregular, but as far as time, and we're trying to standardize it a little bit. So starting April 1st, that's our next one. Sean will be April 1st, Friday at 12:30 p.m. Eastern time, and all of them will be on Clubhouse. And we're trying to do it where we have one a week. So week 1 of the month, Sean will be Fridays at 12:30. Week 2, Chad will do a Saturday morning, 11 a.m. I think he's providing donuts for that one. Week 3 of the month will be Steve, Tuesdays at 7 p.m. And of course, with Steve, we'll just have bourbon. And then week 4, Ryan at 2 p.m., which is lunchtime in the mountains. And I'm not sure what he's providing, probably elk or moose, I would imagine. So we're going to try and have those semi-regular, if there's 5 weeks in the month, or, it starts on a weird day, it won't be exactly that. But for the infielders, I am sending out an email once a week or so, just to give you an update on when those meetings occur. And we're going to do those as long as people are still interested in them. We've had great feedback on that so far. So thank you for all those who are participating. Last announcement, we always tell you what our next meeting is. It is April 25th with Brock Freeman from Kirkland Capital, and he'll be talking about multifamily debt structure. So that's an interesting topic, especially now with interest rates rising. So that'll be April 25th. And so now I would like to introduce Eric Sussman. He's very familiar to us. He's been on our podcast, well, once it's been released, but actually twice. It will be the second episode with Eric will be released April 17th, I believe. We had a great conversation, and so that will be released. This is his second time being a guest at a left field investor meeting, so we appreciate that. Eric is a founding partner of Clear Capital with over 25 years of multifaceted real estate experience. He is also an adjunct professor of accounting and real estate at UCLA's Anderson School of Management. He's been there since 1995, and he's only been voted outstanding professor only 15 times. I just can't believe it. In what, 30 years, 25 years, only 15 times. He's a third generation Bruin, so be kind. He had a rough weekend. But we're really pleased to have him. He is a great friend of Left Field Investors. So welcome, Eric. You have the floor.
Hey, well, thanks, Jim. I appreciate the kind introduction. And you had me really going. I was thinking, this is so great. And then you mentioned March Madness and my Bruins, because we would have this were the matchups, not to get off topic, but it's so unreasonable, right? Because North Carolina got to face St. Peter, and that was great. Nothing like a Cinderella. We all love the underdog. But, we would have made the Final Four if we'd beaten, just could hit a few shots at the end there, but oh well. And with that sobering commentary, I get to talk about inflation and Ukraine and whatever. So anyways, let's get going. Well, it's nice to see everybody. Thanks a million again, Jim. So this, by the way, you may remember this slide. This slide is in every presentation I give because you all want to know what the future looks like. And so I want you to know that I have no psychic abilities whatsoever. I take a lot of data and try to analyze it, make heads or tails of it. So, by the way, the funny thing is, I'll just make a comment, is even my MBA students don't even know who the hell those people at the bottom are. So there you go. Time escapes all of us. So I'll throw these up here really quickly, just in terms of the 22 punchlines so far. It's all been pretty damn sobering. It was already going to be a tough year in almost any sector before the Ukraine situation. And I call it the 5 C's. I guess as a teacher, I'm always coming up with things that my students can remember. COVID, cost, which is basically inflation. China, consumer, what the consumer is going to do post-COVID and everything else, and Congress with the midterm elections and all the political shenanigans. Last year was amazing. I mean, part of the problem is just the comps. Last year was just simply an amazing year. Almost everywhere you look, it was really, I don't think in my investing career, and I'm sure some of you may be investing a little longer than I have, I won't tell you how old I am, but some of you know, mid-50s here. But, I've never seen a year like last year. I can't remember a year where you had commodity prices almost. There's some background noise, everybody, just if you wouldn't mind muting. We had commodity prices almost everywhere you look increasing double digits, and the equity markets, up nearly 30%. Rents up double digits, almost 20%. Housing prices in every single market up the double digits. In fact, last year was the first year in U.S. economic history where every single housing market that's tracked, every single one, housing prices were higher. It's never happened before. Usually have 1 or 2 outliers, but last year was just absolutely nuts. I think the fourth bullet point is probably the most important one as you sort of think looking out in the future. Obviously, the demand side of the equation is always the tricky part. It always is. But supply is a little more predictable because, of course, just the construction cycle and whatnot. And you talk to any builder, and there are challenges, of course. And that was, again, before COVID, before the supply chain issues, before inflation, before labor challenges. Obviously, public sentiment and anti-development sort of psychology is omnipresent, but the others are sort of more recent phenomena. And as I said, 2022 is already off to a fairly challenging start, despite the last couple of days, which have been a lot better. We'll talk a little about these things. I'm happy to do it if you'd like. And that last bullet point is also really kind of interesting. I may have mentioned to y'all in the last call we had, or Jim, it may have come up on the podcast, that if you look at what's called, M2 money supply, for those of you who remember your macroeconomics in another lifetime, but you think about money on the sidelines, basically, money market accounts, savings accounts, checking accounts, you're still at record highs, basically. There's tons of capital still, thanks to the Fed's idiocy, frankly, and HP printing ways. Look, I can't sort of not talk about Ukraine, and I'm no geopoliticist or politician, so don't misunderstand me. Throw this up here in a couple thoughts. Look, I read a lot. I'm sure a lot of you do follow. Whoever you follow that is really an expert in geopolitics. I happen to think Ian Bremmer is terrific. Michael McFaul, who is former ambassador to Russia. I listen to these people. They know more than I do. But obviously, this is unbelievable. It's unlike anything else that we've ever seen. I would only focus on that fifth bullet point, and that is globalization. One of my favorite books, it's quite, it's a little long in the tooth maybe now, and that's Thomas Friedman's The World is Flat from 2003. Still a great read. And this idea that basically when countries are connected in an economically meaningful way, it minimizes the likelihood of conflict, right? Common sense tells you if you've got economic ties to somebody, you're not likely to attack them. Russia has gone from the 11th largest economy in the world. They are now at 20 in a month. I mean, that's an extraordinary feat, by the way, and they're headed even further. Vladimir Putin will have undone 25 years of economic growth in China in a month, which is quite an accomplishment. I assume that's going to be at the top of his CV. And just a couple of thoughts for you to think about in terms of maybe that point on privatization of assets. I had a student ask me a thoughtful question. Well, Professor Sussman, what do you think about that we're confiscating private assets, even though they may be associated in some way with a regime that you don't like or, has done some wrong? And it was an interesting point. I had to pause and think about having traveled around the world and taught in a lot of countries and seen IP violations, let's say in China, when I was there for the first time in 2004, where we're just so open. What footing do we have now when other countries might actually sort of confiscate our private property? And I didn't have a good answer. Food for thought. Anyways, look, the ultimate outcome is unknown. All I can tell you is obviously the inflationary pressures, supply chain pressures, I'll show you some data, are just terribly exacerbated at a time when we really couldn't afford it. And that's going to have consequences for sure. Bigger picture, I always make sure we take a longer term view. Is I think longer term will be fine, but obviously in the short run, it's a little unknown. The one thing about geopolitical conflicts and stock market and financial asset returns is it's a little muddy because they can be very short and they can be very long. And so this one is still unclear. It's a slog. I think that's everyone thinks now it's going to be quite the slog. We can talk about it. All right, getting back to where we all want to focus. This slide speaks for itself. Last year was extraordinary. Everywhere you look, the only asset class which had negative returns were bonds, not shockingly, but barely really. A couple other commodities, but by and large, it was an extraordinary year. Everywhere you look, up and away for sure. I mentioned housing prices, which I know a lot of you are interested in. We can talk about. I told you, basically 20% increases every single market up. I think I've joked with some of you in some of the dialogues we've had in the past that when people are arguing whether the hottest market is Boise or Fresno, it's a strange year. Okay, that's not a normal year when the argument is which tertiary or quaternary market was the hottest market in housing prices. It's just extraordinary. Last year was just simply extraordinary. This is kind of a rainbow chart here of Case-Shiller data. It's only through December because it's a 3-month lag. But as I said, up and away everywhere. Looking here in California, it's a mess. It's going to be a mess, and there's no way out of it. We'll talk about one of the things again. I think I probably mentioned in certainly my writing and elsewhere, of course, the institutional sort of foray into single family over the last couple of years, which has just been remarkable. Whether it's build to rent, buy to flip, and the players there on the right. They've had their problems. Zillow, of course, had some serious indigestion, $2 billion loss from their, I guess, as I joke, the Zestimates were not exactly very good, by the way. So those of you trusting your Zestimates, tread carefully. Didn't work for Zillow. I have been short all of them, Opendoor and Zillow, frankly, since they got into this buying housing business, because I just didn't think it was scalable, and I couldn't understand how a Wall Street firm with all that overhead and SEC reporting compliance could make money on a business that's very hard to scale. I'm happy to talk to you about my views there. By the way, in my opinion, all these are all my views, by the way. I mean, so just tread carefully. I think Opendoor, symbol open, is a zero eventually. I'm still short it. As far as where they bought, it's not going to shock any of you on this call. You all know where they bought and where the rest of us have been buying, and that is the Sun Belt, Southwest, principally, all the way from, again, I would say Idaho all the way down into Texas, into several Florida markets and Charlotte. So just been, and I don't see that changing. That's where the money has been going, and likely its destination. Sort of looking forward. This is, again, I can't remember if I had this picture in my last slide deck to you all several months ago. It's one I present a lot. Just, again, really long-term data. Not that any of us are worried about what happened in 1890, but if you're curious, here you go. Just to sort of look at two pieces of this graph. And again, this comes from Robert Shiller, also at Yale. Real home prices, the blue bar, so home prices after inflation, and the population, sort of that orange line. And, common sense, look, we spend a lot of time in academia, wonks that we are, looking at data and try to think about causations and correlations and all that fun stuff. But, you'd think common sense would tell you population would be highly correlated with housing prices, right? And we'll talk about some population numbers. And you see where it's just gotten out of whack in a few cases, right? Last time, again, before this recent sort of uptick, was right before the financial crisis. And then you see what's happened again. So again, I get asked that question, is this time different? And this time is different, actually, in my opinion, for a couple of reasons. Maybe three reasons. Obviously, the printing press, the Fed. The Fed printed so much money, doubled their balance sheet from essentially $5 to $10 trillion in 2 years, which is just unprecedented. And so the amount of money that's out there has never been higher, while interest rates are basically kept at zero. So you have those two sort of factors, which were big drivers. And then, of course, COVID was something that has never happened in, since Spanish flu in the early about 1918 to 20 time period. But in any event, so this time is a little bit different. Building, supply is an issue, but I'm mindful. I just can't imagine housing prices continue to go up the way they have, and I think they won't. I'm making a prediction right here. But for those of you thinking housing prices are going to drop substantially, my prediction has been constant for the last couple of years, that's not happening. Mainly on the supply side. The problems are really on the supply side. And happy to take any questions, your own thoughts on this for sure. This is actually a really important picture. It's a lot here, but this is maybe the most important graph that I show all of us, in my opinion, at least looking out long term. And that is sort of our population, because if you look out again, and most of us are investing in the maybe 3 to 5 year time period, maybe 5 to 10 years, but I take a longer term view as, you know, as, again, that academic wonk that I am in my spare time, and thinking about demographics and population growth. Globally, fertility rates are at all-time low. By the way, we're just not having as much, you know, sex as we used to. It's a terrible shame. By the way, although my wife won't want to hear anything about that, so be quiet now, or I'm going to get in big trouble. But you know, we're not multiplying. Guys, got to mute yourselves. Here's some background noise. So in the United States right now, the fertility rate per couple is about 2.1. So literally for every couple, we're basically just reproducing. Now, immigration would normally make up for the shortfall, right? That's sort of where, to the extent you've got declining fertility rates, you have immigration, which the United States has always been very, you know, good at, and until recent years. So it's become so politicized on the left and the right. We have to get that right. And I hope these politicians get their heads out of their orifices, because frankly, without immigration and sound immigration policy, it's going to have a material impact on U.S. Economic growth looking forward. And for those of you who are interested in sort of global economies, look no further than Japan, okay? Japan's demographics are terrible, and they've had deflation and basically a really lousy economy for going on 30 years now. That is where we're headed, and I circled where we are headed. So anyway, it's food for thought. I really don't know how many of you are local here to California. I know you're from all over the country, and that's great. Just thought I would just introduce things from California. Obviously, that's where I am. And you know, the politicians here are busy bees trying to deal with housing challenges and the rest of it. The most important thing that they passed in the state was something called SB 9. Not that that matters to most of you, but basically they've modified R1 zoning in the entire state of California now. So in R1 zoning here, again, single detached family residences, now you can build up to 4 units depending on a lot size as a matter of state law now. That was one thing. Locally in Los Angeles, before that, they had passed something called an ADU ordinance, alternative dwelling unit ordinance, which basically would have allowed you to basically modify a detached garage or something similar to add housing units. You know, which again, a political win, it looks great on paper, but it's a lot of BS, because the amount of impact that's going to have is de minimis. You still have to go through local, you know, plan check and permits, and those people are just as incompetent today as they were last year, by the way. News alert. And they're supposed to be granting these permits within 30 days, and they're taking 9 to 18 months now, because again, they don't have the bandwidth to actually process all these applications. So, you know, it's sort of silly. And then again, I won't bore you with California issues. I'm happy to talk to you offline with any of you that are California focused, but we've got our other issues with coastal commissions and the California Environmental Quality Act, CEQA, if those of you know it. Again, our politics are a mess. And this comes from a UCLA professor, so that tells you something. Anyways, on the multifamily, yeah, exactly. Don't hold that against me, left field friends, please. I'm not as woke. My students tell me I'm not as woke as I'm supposed to be. I guess I got my pronouns all messed up. I don't know. Anyhow, on the multifamily track, again, we're clear capital plays and our firm plays. It's again been tremendous. I will say we've got some serious headwinds I'll talk to you about. We're seeing in real time. It's really on the debt side, obviously with inflation. But look, rents are going higher. Rents have been going higher. It's quite remarkable if you look at what's happened with rental rates almost everywhere in the country. Again, double digits for sure. I'll give you some more granular data on that, but it's just been remarkable. And then in cap rates, you sort of again had this sort of double whammy. We had increasing rents and cash flows and declining cap rates, which was just a boon for Clear Capital and many of you who invest in multifamily for sure. Again, I think not that the good times are over, but again, we tend to extrapolate the past exponentially in the future, and I'd be careful. I mean, if you look at this graph, I mean, just look at the blue bars. I mean, that's almost a straight line.
Oops, Eric, I think you froze. If you can hear me. Did he freeze for everybody?
Yeah, he froze for us.
Yep.
Yes, he's frozen.
Okay,
Yeah, I think
thank you.
he's just accentuating that straight line.
He certainly is. We'll give him a second
that.
to there he is. You were out for a minute there.
Oh, my internet connection is unstable. Well, it's always great when your internet connection matches your mental state. Unstable. Thank you. Then I'm done. Thank you. I'll be in Albuquerque on Tuesday, Vegas on Wednesday, and Phoenix on Thursday. Sorry about that. I'm not sure what the heck you missed exactly, but anyhow, I do apologize. But what I was saying was just this whole linear line upwards, where you've had prices going up and cap rates declining almost in a really linear, almost fashion. I just don't see that happening for sure. The rental rates, as I said, same markets that boomed as housing prices. So if I'm repeating myself, I apologize for that. The other thing was kind of unusual. Again, it was so strange where you saw these incredible you saw rental growth, declines in cap rates, and declines in vacancy. I mean, I'm trying to remember in my 30 years in this crazy business whether I remember those kind of things happening all at once. It's just been extraordinary. As I'll tell you, and I think it's on the next slide, just be wary of economic versus physical vacancy or occupancy. There's still, I'm sure many of you have rental units. Collections are still a challenge. In California, they keep extending these moratoriums on evictions, and even if they didn't, try to actually effectuate an eviction through an unlawful detainer action when the courts are so overwhelmed, it's going to be quite challenging. Which is this slide, which they're not updating anymore. The Housing Council is not updating this data anymore. But again, the point is just what I said: is physical occupancy. Almost every building you look at in multifamily is 95 to 97% occupied. But I would tell you, just be very mindful of how much they're actually collecting. That can be a different ball game, and so just be mindful of that. And we're being much more cautious in our underwriting as we look at leases. It's not just who's in the unit physically, but who's paying. That's a big one for sure. On the commercial side, I'll just throw that out. There are only a couple good commercial property indices, in my opinion. Some of you may have heard of GSA or Green Street Advisors. They're very good, by the way, if you want to follow them, for those of you on the sort of commercial side of things. And then MIT has an index, which I've got here, both showing the same thing, which is kind of surprising to people. They'll say, my God, commercial property. They think of office and COVID as being crappy, or retail. The fact is, been doing better than you'd think. Industrial, of course, with self-storage being phenomenal. I mean, just phenomenal. I think I got some data in here that self-storage REITs were up like 70% last year alone. I mean, just ridiculous numbers. And office, even with the office issues, actually the pricing has not gone down, even in COVID, which again is probably a reflection of the amount of money that's on the sidelines, and of course the thinking you got to be ahead of the curve when things get back to normal, whatever that looks like. Anyways, food for thought. I want to show you a couple things because, again, as Wayne Gretzky said, and I quote him all the time on this one quote, is it's not where the puck has been, but where it's going. And, you take data and you tend to look at it in these, annual bases or whatever. If you sort of look at more short run, what's been happening, we've definitely, on the left side, seen sort of maybe it's a temporary thing, we'll see, but a change from sort of growth back to value. For those of you who are value investors, it's been a rough decade. It's been the roughest decade for value investing in history, frankly. The red line, or whatever color you'll call that, is the ARKK Index ETF. I don't know if you know Kathy Wood. I've mentioned her before. If you want to actually look at an index, which is the highest of the highest high flyers and the biggest gambling stocks, look at ARKK, and you can see it's gotten shellacked over the last 6 months. And the blue line is the boring Warren Buffett Berkshire Hathaway, which has been doing quite well lately. So maybe things are turning the corner. On the right is just a little more granular look at the monthly changes in rents. Through the last first half of last year, rents were on an absolute tear post-COVID, sort of rebound. But that rate of increase has been dropping. So just be aware of that. I still think in a lot of markets, we'll see 8 to 10% rent growth versus some of the projections we're making. But just, be aware, again, with all the uncertainty out there, things can change fairly quickly. This is just that ARKK, what a cluster mess. I'm short this as well, by the way. I've been short this for quite some time. By the way, again, be careful. Shorting stocks is quite dangerous. You can see how it's done in the last year. She's a gambler. Kathleen Wood is basically a gambler, and all that. As far as the equity markets, this is before today. This is as of Friday, so I'm not sure I have to belabor this very much, other than to just say I'm unstable again. Am I frozen again, or can you hear me? All good. Okay. You know, it pops up. Your connection is unstable. As I said, I need that for my mental state. I just want to show this to you, just because, again, I think it does pay to pay attention to history. And look, most of you have, you know, I hope you don't take this the wrong way, but some gray hair, so you've seen markets. But, you know, I never forget that when I'm talking to my MBA students who are whopping 28 to 32, they've never seen a bear market. They have never seen one. Your kids never seen one. Your niece, you know, I don't know, it depends on how old you are. You know, my nieces and nephews never seen it. And so they lose perspective. They just think the markets always go up and buy Bitcoin, and that's your, okay, sorry, claim to fame. You know, but look, this graph speaks volumes. We had one down year before this year, 2018. And as those of you who've heard me mention, that was December. The first 11 months in 2018 were up except for December. We haven't had a real down year since 08. 22 remains to be seen. Obviously not looking good right now. And I'd be surprised with the inflationary headwinds that the equity markets are going to, and Ukraine, of course, are going to be able to repeat their performance. But a lot of money out there, we'll see. I had not shown this in a little while, and I just want to show you REIT stocks. For those of you who are, again, invested in real estate in various capacities, I know a lot of you, some of you probably have investments in real estate investment trusts that are publicly traded, obviously been extraordinary run as well. And last year was extraordinary as well. And this year, a little more sobering, mostly down about 8%, which again is far less than the NASDAQ, but it's about double the loss of the S&P 500 year to date, something like that. But again, and okay, this is a lot of data, so don't be upset, but this is by sector. Just, you know, not all sectors are created equal, as I mentioned, and you can sort of see, look, the self-storage, you know, if you have any data about self-storage, Storage Wars tells you everything you need to know. Americans love to store their crap and overpay for it. It's amazing. The only regret I have, because of course, you know, multifamily has been amazing, so I shouldn't complain, but sometimes I look jealously with envy at my self-storage friends. Industrial also been extraordinary, but you can see this year, everything's pretty much down across the board, mostly about 8%, which is not great, but it's, again, better than the NASDAQ. I can't remember if any of you've seen this before, but it's called the VIX. It's the volatility index. It just shows you how volatile things are. But I just want to, again, history is instructive, and we think if markets are so crazy volatile right now, but just don't be hoodwinked or fooled. The fact is, yeah, they're more volatile than they maybe were last year, as complacent as the markets have been. But give me a break. They're nowhere near what happened in March of 2020, at the beginning of COVID, nowhere near the financial crisis, not even half as volatile. So, and today's a good example. The markets were, you know, up by and large today in the face of all this. And we've had, what, 3 or 4 decent days in a row. Not that that means a lot, but just don't be fooled. Volatility still is actually well off highs for sure. I mentioned this earlier. This is something we all need to sort of track and think about. The Fed created a monster, an absolute monster. And that's creating all this inflationary pressure we'll certainly talk about here before we say our goodbyes. But there's a lot of cash on the sidelines, which is, again, they printed like freaking crazy, double the Fed balance sheet. And so everywhere you look, households, corporations, there's record levels of cash sitting on the sidelines. Yeah, you can see that $20 trillion over there in the middle slide. So again, how we think about this, how is sort of interesting. You know, I'm sure many of you have cash burning a hole in your pocket. You're wondering, what the heck do I do with my cash earning negative real returns of 8%? You know, that's a real challenge, and we're all kind of nervous, not sure what to do. All right, look, I could show graphs on graphs of inflation. And I've been talking about inflation for some time. I am not shocked by that we're experiencing it. Maybe a little bit that it's as high as it is, but inflation's running at 8% right now. It's not transitory, obviously. Jerome Powell, our Fed chair, is got to be Houdini or the best seamstress that ever lived as he tries to thread this crazy needle, and we have risk of stagflation. I'm more curious, and I'd love your thoughts, frankly, because, the interesting thing is, again, we have not had inflation like this, of course, as you've read, 40-year highs, this headline or that headline since the late 70s, early 80s. And for those of us who lived through the 70s, we don't remember it anyways. Sadly, we should forget the bell-bottom jeans and the polyester, but that's a separate issue. But I am curious. I am very curious how people respond to month after month of high inflation. I'm not sure because we haven't seen it before, and I am unclear on that myself. Expectations are very significant when it comes to inflation and how consumers respond. And I still think a lot of consumers are living in the past. I don't know, look, how many of you again are California. I was with my wife driving on the 405 this weekend, our favorite freeway, and it was packed. It was as crowded as any freeway you'd ever see. I'm thinking, well, gas prices are $6 a gallon here. You sure wouldn't know it. So people have not quite, obviously, changed their habits. Maybe it's this pent-up COVID demand, or this maybe denial. My favorite river, denial. Thank you very much. That will not be making my sitcom, my comedy routine, frankly. Anyhow. The other thing is, if I asked who were prices were highest last year, of course, used cars. So used cars, continue to lead the pack. But almost everywhere you look, there's inflation, and it ain't going away soon. So we can talk about that if we have some time. Oil prices. All right, look, the point of oil prices is this next slide. Okay, there ain't nobody who can predict oil prices. I first heard that from a UCLA professor in policy 20 years ago who said that he had studied this for his career and no one can forecast it. And here you go, from Kathy Wood, my favorite, to Jim Cramer, booyah, to Goldman Sachs, to this pundit or that pundit. You cannot predict oil prices. OPEC can't predict oil prices. So, forget about it. Other few commodities you may have heard about. Nickel. Nickel has just boomed. There's a huge short squeeze that's really squeezed the heck out of some Chinese banks, actually, believe it or not. And I'm not sure where that falls out. We'll see. Wheat prices. Wheat prices are at all-time high. By the way, these captions, I took a long time thinking about these for sure. Anyways, but the wheat prices at record highs. And so that's going to be inflationary pressure. There's just so many little pieces of inflationary pressure. And this is really Ukraine. Russia's an exporter of wheat. So problem, to show you this, not that it matters. But again, it's remarkable. The Russian market was closed for a month. It just opened a few days ago, as you may know. History will not be kind to Putin. And again, when you're living through it, and I don't know how many of you are history buffs, I love history. It's always been a passion of mine. I guess it's, if you forget it, you're doomed to repeat it, or maybe it doesn't repeat itself, but it rhymes, to quote Twain. But in any event, history will not be kind. And these are nut jobs. Putin is clearly not dealing with a full deck in terms of advice and objective reality. And he's not listening to advisors, obviously. And it doesn't matter. Great, you got a sociopathic leader of one of the largest countries in the world, and he's making things very miserable for lots of people. Again, forgive this, rainbow chart here. This is the yield curve at 5 different dates. So the green line in the middle is the yield curve, U.S. Treasury rates as of Friday. And you can see the yield curve has shifted up substantially from the yellow and blue lines, but we're still below, longer term rates. So, again, we get suckered into the short term. We're still below those, but the yield curve is very flat right now, actually a little bit inverted from the 5 to the 10-year yields. But it's just the rate of increase. We've had just an incredible rate of increase now up in the 10-year up to almost 2.5% now, which is just, it's the rapidity of that increase, which is just, I think, left a lot of us sort of stunned. Okay, I just downloaded this on Friday. This is the mortgage rates as of Friday, where you can see we're basically at highs of the last couple of years on mortgage rates, 442, and I don't see that any relief there for the short run. But I mean, what does that mean? Again, just to make sure we're clear, obviously that means affordability on the margin for single family is lower, and that's good for our business. Obviously, for those of you who own rental units, that's a good thing. Obviously, it means people aren't going to be able to buy homes. But honestly, people weren't able to buy homes before. So I'm not sure how meaningful that is. It's on the margin. We'll see, I suppose. Globally, I'll show you this just for those of you who are interested. Rates are going higher across the globe, basically, in most markets anyways. They're increasing rates to combat inflation, which is again going to mean global GDP is going to be impacted, as of course the US GDP. This is just to show you we've never dealt with these times before, and it's always tricky, like I said, trying to predict the future and make make sort of logic out of all this disparate data and things you've never seen before, where again, you're running now at a negative, real returns of now negative 8% because of, well, again, we're now at 50 basis points on the Fed funds rate and inflation's running 8%. So you're negative 7.5%, never seen it before at that level. And if you look back, the last time we were near it was the late 70s and early 80s. And for those of us who lived through that period of time, remember, we don't want to be back there. That was a dreadful time for the equity markets and for investments generally, until basically Volcker came in. Housing supply, just again, these are the biggest buffer. I would tell you the demand side is always a little bit murkier for me and probably for all of us, but supply is really the challenge. And those impediments aren't going away, as I said, from higher commodity prices to labor shortages to NIMBYism to permit granting, the lack of buildable lots. I can go on. That's where the real challenge is going to be. As far as inflation goes, and again, I some of you may have seen this in my talks recently, what's going to happen with inflation. The good news is that a lot of real property has done very well during inflationary times. So that's good. Land, of course, goes up in value. What I would tell you all, my advice would be just, if you're going to invest in any kind of leased asset, of course, it's multifamily to, single tenant retail leases to Walgreens, you've got to be very careful with the latter to the extent that you can't adjust the numerator, the rents, with inflationary pressures. Your denominator, the cap rate, basically is going to go up by and large with interest rates and inflation. So if that happens, you're going to have value destruction, lower prices. So you've got to make sure you think you're very mindful about how you can adjust the numerator and how quickly. I've seen residential rents. That's probably as fast as you can. Maybe hotels. I mean, by the way, I'm in a hotel, by the way. Can you tell from the curtains? Yes, these are not my house curtains for any. I may not have much taste, but I got better taste than this piece of crap. My God. The brown neutrals, nothing like a Hyatt. But I got to tell you something. I won't tell you how much I'm paying per night here at a conference. Unbelievable. And the hotel is packed, by the way, absolutely packed. Hotels are doing great. They're going to have big ADRs, average daily rates, because they're able to adjust those rates with inflation, right? Overnight. Multifamily is next, followed by industrial, office, and so forth. So just be mindful of that. I talked about this already, population growth and so forth. The one on the right is probably the more interesting, which is not shocking to any of us listening in. Population growth has mainly happened in the Sun Belt and Southwest. So it's, yes, I guess I'm not sure you can say go south, young man. My woke students at UCLA would be very unhappy with that economist caption. Anyways, cisgender male is the right term. I've learned that, by the way, for those of you listening in. So those are the good markets. I think these are going to continue to be great markets. It's mainly where Clear Capital is looking, I would say, from the Pacific Southwest, Mountain West, Southwest, into the Sun Belt, for sure. And again, that's where we're looking, and it's where the puck is going, the people are going, and that's where they're headed. And part of it, I just would add here real quickly, is, certain markets were sort of, maybe bedroom communities, or that people would just sort of move snowbirds. They were sort of transient population. That's not true anymore. Obviously everyone knows Texas, the Texas story, but even places like Phoenix, Taiwan Semiconductor, Intel plant down there. There are real jobs, real manufacturing in a place like Phoenix. Eugene, Oregon, where we just bought a property. The two most recent billionaires, if that's any reasonable metric, were tech. those, Phil Knight and Nike were closely tied with Eugene, Oregon. That was the entire city almost, and the university there, and now tech. So tech is really creating a lot of jobs outside of California now, and university towns, great places too, by the way, with all that tech knowledge and whatnot. Labor, I'll throw out labor. How are you doing time, Jim? Hopefully okay. I know you'll give me the red light, or you'll pull the plug on me. I know you well enough when my vocal cords get a little out of control. But look, labor, it's fascinating too. We've got 11.5 million job openings now, and according to the Bureau of Labor and Statistics, 6.3 million unemployed. So there's this disconnect here. Wages are going higher. The job market's actually doing fairly well. The type of work is going to be interesting, remote and this hybrid, which a lot of us are dealing with. But wages are going higher. At Clear Capital, I mean, we're increasing wages across the board. I'm sure those of you who have employees know exactly what I'm talking about. It is a real challenge, and maintaining and retaining talent is very, very tricky. And that's global again. That's not just a U.S. phenomenon. That's global. And look, the one on the right may be controversial. I know, this gets into politics, and I try to be very mindful of not getting into political waters because I know that can be dangerous. But look, I'm somebody who, I'm kind of a centrist. That's not going to shock any of you here. But I actually think we need to sort of do something with the wealth inequality. Again, I'm not sure the best way to do it. I think there's probably good ideas on both the left and the right. It's got to come to some compromise, but I think wages have to be higher. And that actually is good for our business. Maybe I'm a little biased because of multifamily. I want our tenants to be able to pay more rent, which means they have to have more household income, obviously. I could show this in a million different ways, and look, those are my views, and hopefully the politicians will do the right thing. God help us. So anyway, so this goes to show you that disconnect on housing prices and earnings. So that's why people complain about affordability. So I'd love for people to make more money and pay more rents and be able to afford more housing. It would go a long way. Of course, that's inflationary pressures, and so we're trying to balance all these things out to some degree. I could show you this in any graphical way that you see. And last, I think it's one of the last things. I don't know why it's here, but people ask me, what do I think about cryptocurrencies? Don't ask me about cryptocurrencies, please. It's a gambling mechanism. I got in some argument today with someone on Bitcoin at this conference. I don't know. People are evangelical about stuff. I don't get too evangelical. I'm a bean counter basically at the core. So, I mean, look, you can't have a currency, a fiat currency that goes up or down 30% in a matter of months. You just can't have that. And very few transactions are being consummated. I will say, as far as real estate, people talk about the blockchain and NFTs for things like title insurance and deeds. Maybe that's one area I think we need to disintermediate those markets, I think, to some degree, because they're archaic, way too expensive and whatnot. And probably there's something along that sort of crypto, not with crypto, but with blockchain and NFTs that could make some headway there. But now I'm over my pay scale, so I'll leave that to others. In summary, and I'll take any questions you want or comments, and you can tell me when I'm full of it. I don't mind that at all. I'll tell you in response while you're full of it, and we'll have a wonderful détente. It'll be perfect. That's one thing about talking about the economy and the future, right? We're all full of it. We all don't know what the hell we're talking about. But as I said, I really thought this was going to be a tough year even before Ukraine. And now, I mean, you add that the geopolitical risk, you add in the Federal Reserve complications, and what is Jerome Powell trying to do? Is it going to be 4 interest rate increases or 6 or 8? Is the next one going to be 50 basis points and all that? I'm not sure I have any more clear visibility than any of us, by the way. It's so uncertain to me, but inflation is here to stay, and I think he has got a very tough road to hoe. I would say this, though, those that are predicting stagflation are wrong, mainly because of the pent-up demand from COVID. I mean, like I say, I look at data points, and I really encourage you to just pay attention to stuff when you're, at a hotel or whatever. I'm at this conference, it's packed. The hotel is packed, adjacent hotel packed, people are traveling, I see lots of families. So I think that's going to be a stronger counter balance to the inflationary pressures and other sort of headwinds with GDP and economic growth, is the pent-up demand from COVID, and people have had enough. And by the way, no one's wearing masks here in California, okay? So when when I walk into the hotel and no one's wearing a mask in California, either I'm in Oz or Rod Serling is about to tell me I didn't read the signpost up ahead or something that, by the way, because it's definitely a change here for sure. Housing market, I think, is still going to be going up. I don't see any downward pressure there at all, that on single family or multifamily, although I just can't imagine a repeat of the, almost 20% increases in both last year. I just can't foresee that. But those of us thinking prices are going down, we're waiting for Godot. One last thing I'll take questions is variable rate mortgages. I don't know if any of you have floating rate mortgages. We do at Clear Capital on some of our assets, and we're going to get some nasty adjustments. I think rents will go up enough, but it's something that's given me a little bit of an acid moments, put it that way, as we sort of think about that. And that's it. That's all I got to talk to you all in our 45 minutes. It's a backup slide. Why don't we just, if there's any questions or comments or anything else? I don't know, Jim, how you want to do this. I can't remember how you did the last time. If you just from the chat box, you can chime in.
Either. I think if we can stop the share, then I can see everybody. If you just want to, if someone wants to type in the chat, that's fine. Or if you just want to unmute and I'll try to see you. Or we have quite a few people here, so you could also just raise your hand virtually. Eric, as usual, that was fantastic and chock full of data and information, and it was awesome. So I'll kind of pause here and see if we have questions.
And by the way, you're more than welcome to have my slides. As a teacher, I believe in transparency, so if you can have them. Okay, if you use them in any other presentations, just give me credit or something. That way, no, I'm just kidding. I don't care about that. But you're welcome to have the slides too, by the way, if you like.
Okay, if you could email those to me, I will include them with the recording that I send out tomorrow.
Will do, Jim. Okay,
perfect. So questions?
Oh, come on. As Kaja Gugu once sang, "You're too shy. Hush, hush, eye to eye." Thank you.
Hey, Eric, I've got one, and you
sure,
you hit on
John.
This. Yes, the guy with the photo that Jim likes to make fun of. You hit on this pretty early on, and I've been saying it for quite some time, but I don't know if it's true or how true it is, or if it's manufactured. And that is the fact that inflation is not.
Sean, I don't know if it's you or me.
Uh-oh.
I can hear you,
now?
Sean. I think
Sean, you seem to be coming through okay.
Yeah, he just froze again. There you go, Eric. How about now?
Yeah, so I'm not sure that's you or me, but you froze there, Sean. Maybe I apologize. I'm in this hotel room.
No, that's all right. Yep, I'll try again. So inflation doesn't seem to have sunk in for many. And I've been saying that this COVID effect is very real, and that people are just so smitten to get out, do stuff, vacation, drive, go see people. But I don't know if that's manufactured, if I'm just making that up, or do you think that's a real issue right now?
It is, Sean. I told you this. I mentioned, I think you're 1,000% correct. I told you the 405, the freeways in LA are as packed as they ever were. The hotels here are packed as they've ever been. The flights that I've been on, I don't know how many of you've gone back to flying, and I'm sure it's kind of mixed for some of us, but packed. I mean, the load factors, I think the airline, now they've got fewer flights, so obviously it's a little deceiving, but the load factors are high. So I'm with you, Sean. I agree, and I'm curious what will happen, when we have 3, 4, 5, 6 months of 7 to 10% inflation, prints. I'm curious because I said I'd love to hear. I mean, Sean, what this is where I get to cold call you. This is the business school professor type. I mean, Sean, I'd like to hear what you all think. I mean, what do you think? How are people going to respond? This is important for all of us to think about when we've got double-digit inflation prints for month after month, which no one has seen in 40 years. And again, your kids have never seen it. Probably some of you, the younger ones on this call, which I really don't like, by the way, have never seen it. As middle-aged folks, we probably remember the late 70s and 80s, God help us. But I'm curious. I really am curious what y'all think. I mean, Sean, you mentioned Sean, any thoughts on that?
Yeah, I don't know if it's a combination of people don't know what to think, or if there's so many people in that age bracket that you mentioned that are sitting on so much cash that they just figure, okay, this is why I've been sitting on this cash. I'm just going to go ahead and have to use it. And I think there's a lot of talk that prices aren't going to come down. And are firms and manufacturers and operators going to just take advantage of the consumer and take advantage of the marketplace and just leave prices where they are? And so I think people are happy just to continue to sit on that cash because they view it as, this is why I've been saving it and stuffing it under the mattress for the times like this where I'm going to have to use it.
Yeah, that's an astute point, Sean. I think linking the M2 data I gave you and all that money with the inflation, people are just figuring, you may be right psychologically saying, well, yeah, I'll pay $500 a night at the Hyatt and it's, 200 more than I was going to pay, but I got the cash I've been saving up. It's so we'll see how that plays out. That's a good observation.
I also think there's just so much going on that it's hard to figure out what's what. Eric, when we did our podcast, I listed off several things that are, the worst of my lifetime. And I said, is this one of the worst times ever? And you laughed and rattled off, much worse times, which is true. But I think when you add in, COVID and politics now and Ukraine, it's just hard to know like what's causing what.
Amen.
And everything, we're going to have to start doing some manufacturing here instead of overseas. So that might cause even more inflation. I don't know. And then the one question I had was, this Ukraine issue, is this going to cause the vanishing of the petrodollar, right? Because it used to be the dollar was backed by gold and then it was kind of backed by oil for the last 50 years, basically. Now our country's going to say, well, if we don't do what, the United States or Europe want, we're going to stop using dollars. And how does that affect us? Does that even accelerate inflation?
Okay, well, I'm not even the best person to talk about that latter point, Jim. That's a very complex topic, and I always know my the four corners of my knowledge. I mean, that's an interesting issue looking forward. I don't know. Just one comment I was thinking, we were saying where we talked about all these bad things. By the way, if any of you want to know that things could be worse, I'll give you my mother-in-law's phone number, and you can call her. She'll make sure she tells you how much worse things can be. By the way, it's whenever I'm feeling good, I call her, and it's like a human downer. Anyways, Jim, there are all those uncertainties, and uncertainties are never good for markets, right? And that's one thing I think as investors always can appreciate. Markets and investors don't like uncertainty, and we got so much of it now. But I would say, look, one thing about Ukraine, its impact, again, it's obviously the media is all over it as it should. It's an important event geopolitically, but from an economic standpoint, it's a rounding error actually in the world. Ukraine's economy, it's actually the second largest country in Europe, but it's actually economically not, adds very nominally to GDP. So it's more the psychology, I think, of things. And the media has a very powerful impact. I think that's the question mark. But I think it goes to Sean's point. There's a lot of cash, people have been pent up. I think a lot of us, I'm sure a lot of you, I know I feel the same way. Getting out and going to enjoy life again, is something I've been longing to do. And fortunately, I'm in a position where I can afford to do it like a lot of folks. So I don't know, but your latter question, as far as the dollar and petro, I don't know, Jim, I'm not sure how to think about that. I'll give it some thought, but I don't have a off the cuff answer for you now. And I don't want to be flippant.
That's all right. We got another question from our best Buffalo. I like the change of teams, David. Thank you very much. Go ahead and ask your question.
Yeah. Hey, Eric. I was wondering if any of the markets you guys are active in for multifamily, are there any that actually have some supply that stands out, like some where there actually is new supply coming online versus?
Yeah, those are, yes. The markets that have always, the market that actually has always just troubled me or plagued me is Texas. I used to say, and I'm sure there's some of you from Texas, and I hope you'll forgive me, and it wasn't said to be, critical, but, Texas was a place where equity went to die. I used to say that a lot. And what I meant was you could always find higher yields on Texas real estate generally, but because supply was always an issue, so much land, and of course, permitting in Texas, you don't have the permitting issue, the zoning challenges, and you certainly don't have the NIMBYs like you do in California. So I would be as much as Texas is growing in every way, shape, and form, it doesn't mean it's an easy market to make money. And and I think the supply challenges are sort of impeding rental growth that you'd otherwise see in the Texas markets, I think.
And you mentioned that you're traveling, you said Phoenix, Albuquerque, Vegas. Are those markets where you have assets, or are you
Yeah,
exploring
no,
those for new?
Oh, David, that was me, just off my sense of humor. Phoenix, yes, but Phoenix has got, look, if any of you had told me that cap rates in Phoenix would be in the 3s, I would have stripped down on my skivvies and run across the Hyatt, parking lot. I mean, I know that's a visual none of you want, by the way, but in any event, it's crazy, right, David? I mean, just nuts. So Phoenix, we're actually selling some stuff. We're just listing a property in Phoenix now for sale that we bought last year, Urban Park. And I don't know if you happen to be invested in that one, but it's unbelievable what's happened there. Vegas is a tricky market, not really looking in Vegas. Here's my thought about just a sideline, David, your questions, and I tell all of you, I generally avoid any market that is basically one or two industry dependent, sort of, where, obviously Vegas is still, of course, we all get it, tourism and gambling, doesn't have a lot of industry. And so I avoid that market as much as, it's boomed, admittedly. Phoenix, I told you, I would not only look at Phoenix, but Phoenix now has industry. Albuquerque, we looked at Albuquerque, David, we didn't find any projects we liked in Albuquerque. So I would look there. We didn't like Boise for multifamily. We were passing on Boise, passing on Albuquerque. So stay tuned. It's getting much trickier. We've got to sharpen our underwriting pencils, I think, for sure now. We got a few hands. Wow, this is exciting. I got hands now.
John, I think you were up next.
Yes, I have 2 questions. I'll ask the first one. You as an operator, what would you say the top 3 risks are going to be for you as an operator, as a sponsor, this year and next year?
The top 3. God, I hate questions like this. It's like you're gonna hand me Aladdin's lamp and tell me I got 3 wishes. All right, sex and pizza are 2 of them. Let's see. That's really an unpleasant thought there too. I would say number 1 is to the extent that we do have floating rate debt, and we've used at times adjustable rate debt. Look, part of it, did you say it was John? Was it Jeff? Jim? John. So, part of our strategy, and probably some of yours and your own portfolios with other operators, whether it's Clear Capital or others, you're doing value add. You're doing sort of bridge financing to perm, right? You're not going to get permanent financing on a value add project. That's a total mismatch. By definition, bridge financing is variable. So that's number 1, is just how do we deal with the repricing of adjustable rate debt with a value add strategy, which requires sort of that sort of financing. That's number 1 in my mind. Second is collections versus that physical occupancy, and just dealing with tenants that have either because of moral hazard in some cases or whatnot are not paying. And we still have challenges across the portfolio and you can't evict people. And like I said, even if you have the legal right, because the moratoriums have ended, at least in California, I know you're from all over the country, but you're in this ridiculous queue now to actually effectuate evictions anyway. So that's going to be number 2. And number 3 is, I would say, labor. We're having as much trouble as probably many of you and others in attracting, retaining labor in the property management business. Our business is absolutely dependent on good people. So, those are the 3 that off the top of my head. That's a really thoughtful question, by the way, when you asked me, but I think those are three that I think, even with more thought, I'd say those are probably the 3 biggies. What's your 2 for? What's your second one?
My second question.
The second one, John.
My second question is actually for Tanya. I think Tanya's on the call. What is it really like to work for Eric?
Oh, shit. I gave her her annual review already in her raise, this year. So
is that fair? Like, am I really expected to answer that question?
Yes, absolutely.
Oh, come on.
No, I'm just kidding. So I don't know how many of you know this, but I was actually Eric's student when I was in business school at Anderson. So I graduated in 2005, and I was smart enough to stay in touch with him because now, more than 15 years later, we've reunited, and I'm the first MBA Eric's ever hired. So I feel that's been, and anyway, it's been great. It's been the company itself is just growing like gangbusters. Eric is incredibly smart, which it can be a little bit sometimes a little overwhelming, but it's also very stimulating, and it just keeps me on my toes and forces me to be the best that I can be. And he's also incredibly understanding. I'm a mother of 3, and for those of you who heard the podcast that I did with Jim last year, in my prior world of 15 years in wealth management at Goldman Sachs, there wasn't a lot of understanding of that. So I feel fortunate that I have that in Eric and the company as well. So all in all, it's been wonderful. I feel very fortunate and grateful to be at Clear Capital and with Eric.
I'll just tell you one funny anecdote. That's a funny question. So when Tanya first started, new employee, she emailed me on Saturday or late Fridays trying to impress me. And I said, do not do that. Go spend time with your family first. And I mean it. So, fortunately in our business, we can do that. But thanks, John, for that question.
That was a good one.
That's funny.
All I heard was that Eric is overwhelming. So I concur. But so we're right at 8 o'clock. We have 2 more questions. We'll go to Rob, and then we'll do Steve can end it because he has something else to say to everybody as well. So Rob, go ahead with your question. Oh, we can't hear you, Rob. There we go.
Can you hear me?
Yeah.
Eric, thanks for the presentation. Looking forward to seeing the slides in detail. Quick question. From what I understand, in New York City, conversions from office to residential is happening quite a bit. How broadly do you see that happening across the country, and is it going to be impactful in the supply issues?
Yeah, Rob, this is where I don't have the data, so I want to be careful. I don't know. That's what people are talking about, of course. Look, I have heard for so long that we were going to repurpose, of course, dead retail, dead bricks and mortar, and now office. I'm cynical. It's moved at a much more glacial pace than I would have thought, actually. Take all the dead retail, all the shopping malls around, a lot prior, or in places where you all live around the country, and it's just not happening, again, for whatever reason. I think part of it, again, is just you have the impediments on the supply side, Rob, in terms of, again, material, labor, and permitting even. So I think it's a good story, but I think minimally impactful, but I'll wait and see the data, but I haven't seen it yet, but I'm more dubious than probably. It's a good story, but that's probably all, but we'll see. I'll when I do the next one, I'll try to get some data for you, Rob.
All right, Steve, final question, and also mention the networking as well, please, Steve.
Yeah, so in the chat, I put the networking on wonder.me. It's the app that we've been using, or the link we've been using. So when you get in there, make sure you close your Zoom so you don't have like reverberate, other sounds. And then the password is LFI22. And if you go there, you have to move. If you haven't been on there before, you have to actually move your cursor around, or it's your face, I think, and then you join a group or whatnot. If you want to talk to one person, you could actually join them and just talk to them, and then you'll see like a circle form around you. So it's a really cool app if you've not been on there. And if you get bored with the person you talk to, just move out and then talk to someone else. So, but thanks, Eric and Tanya, for coming to speak with us, and hopefully you can stay a little bit for the networking. But Eric, you mentioned the interest-only loans a few times, and I was just curious, when you guys are underwriting now, are you taking that into consideration, or are you also looking at agency debt as well?
Well, okay, just to be clear, Steve, and by the way, it's my pleasure, everybody. A couple thoughts. I will hang around for the networking a little bit. I have to head back to this conference, but I'm happy. And Jim, I'm my email address. If you Google, as a UCLA faculty member, you can find me. I'm happy to answer questions offline, or if there's something you didn't feel answered or you didn't want to ask here. I enjoyed those conversations, so it's no problem. I just want to make sure we're not conflating things, Steve, between two things. One is sort of the floating rate debt with the interest only. They're two different things. You can get IO or interest only debt on your fixed rate products. So just want to make sure we're not conflating things. As I said, the variable rate debt is just of concern because, of course, there's a few moving parts there. One, of course, is the increase in yields and rates, of course. I would say two is the end of LIBOR. So that's been creating some issues and challenges on floating rate debt. And that's been, which of the, this thing called SOFR, some of you have heard of, and I won't get into all that, but what index you use, the adjustment period, and then the spreads also, which also affect fixed rate debt. The IO piece, the interest only piece, is not an issue. You can still, with agency debt, get, probably 3 to 5 years of interest only, whether it's floating or fixed. So that's not an issue still. But I think the underwriters are just I'm telling you all the spreads now, and they're just more cautious with what's going on. And I don't know how many of you remember, again, the fall of 1998, which is another lifetime ago, when the global capital markets froze. This is not the same as then, but it's as bad as a time in underwriting as I can remember since then. Of course, the financial crisis, I suppose. But anyway, so IO is not an issue. The bridge debt and the floating is more problematic. I hope, Steve, that makes sense.
Oh yeah, I'm sorry. I guess I didn't ask the question correctly, but you answered my question.
Okay.
Yes. Yeah.
It's okay, Steve. You're getting a B+, unfortunately now. That's unfortunate. I was going to,
Right.
you were in the A range, but I just lowered your grade because you asked the question. That's okay now.
Excellent. So, Eric, we cannot thank you and Tanya enough for being here. You have been a fabulous partner for Left Field Investors, and we really appreciate it. And you can tell we had up to 52 people, which is more than we usually get. So we really appreciate that. We would love to invite you to networking. I understand you have a conference, so if you can show up, that's great. It has to be on a computer. The link is in the chat. You have to scroll up a little bit because some other things have been added. Also, Tanya put in the newsletter, which is, I read it every time it comes out, and I think it's quarterly. It's great. It has all the charts, all the stuff, and it has a little commentary, and it's fun to read. It's entertaining. So I will put that in the newsletter tomorrow as well that I send out. But for now, I'm going to close Zoom as soon as we get done here. So Steve is opening up Wonder Me. So for those of you that would like to network, please close out Zoom, head over there. You got to be on a computer. And the next time we will see you is April 25th for our next meeting. Thank you all very much. And thank you so much, Eric, Tanya, and Clear Capital.
Thanks, Eric. Be well, everybody. Thanks a million.
Thank you.
Hi, thank you.